how do you manage risk in that environment where we get these bad headlines that are consistently seems to be ignored by the market in favor of the projection of a vaccine in a better back half?
Well, look, I think there's two sort of key things. The first is really hard to forecast what risk events are actually going to matter, and I think that was really the big lesson out of this year. Is people like to think they can forecast the bad events, but they basically can't. And if you can't, then you need to prepare yourself in a way where you have, in my view, very reactive risk management to the news as it comes through. And certainly that's what helped us this year, was not thinking that we could forecast what was going to happen with the pandemic, which I don't think anybody really could, but being very reactive as events unfolded.
Do you think, Sandy, that volatility is appropriately priced when we think about next year and how negative shocks may be impacting the market?
Well, so I didn't forecast there was going to be a pandemic in 2020, so I don't think I can forecast what things will happen in 2021. But equities, and especially the US market, are much less diversified than they used to be by sector. The S&P 500 is much more concentrated in volatile sectors and has had a significant decrease in weight in the less volatile sectors, things like energy or industrials are a much smaller weight than they were. And as a result, you've got a less diversified market. It's almost certainly going to be more volatile. It feels just like the late 1990s when you had volatility levels. The VIX, for example, was typically in the low 20s in the early 90s.
Do you think the market is suffering from groupthink?
Well, it's certainly suffering from groupthink from the perspective that I think almost everybody thinks that the vaccine is going to be the cure-all. When I talk to investors, perhaps the biggest concern that people have got is a mutation of the virus. None of us are going to be able to really forecast whether there is a mutation, and if there is a mutation, whether existing vaccines will work or not. So you can't really sort of build a strategy around that. And if you recognize you can't build a strategy around it, you have to go elsewhere. And I think that's really saying, at least from my perspective, we are likely to stay in a higher volatility world for some time, perhaps multiple years. And that would be my view, that we'll stay in it for multiple years. And if that's the case, then make sure that when you're designing your investment strategies, you're robust to that.
How do you design an investment strategy right now? Sort of what is your top thought? What's your top pick? What's your top process? What's your top macro thesis?
Well, look, the first thing I can say is that most strategies which have done well over the last 20 years have really been designed to work in a world of quite low volatility, where every now and then something bad has happened, but most of the time we've had a VIX in the range of 10 to 15. They haven't really been designed to work in a world of 20 to 25, which is my base view. That's what we're going to see. And as I say, we had that for a long time in the last period of really strong tech strength. Amongst the strategies that are likely to do well in an environment like that would be momentum strategies, where trend following strategies, which really try and latch on to trends. And we view those strategies as being long volatility, structurally exposed to making money when volatility is high. So there aren't that many strategies that will do well in a higher volatility environment, but that is certainly one of them.
Sandy, this all draws questions about quantitative investing as well. What types of strategies will just not work in the future anymore? And how do you define quantitative investing for the future?
So why don't I start with the second one, defining quantitative investing for the future? I think that all investing strategies have become more quantitative over the last 10 or 20 years. The sorts of technologies which were unimaginable 20 years ago, essentially every investor has today. And we're going to carry on moving in that direction. So all investors, both quantitative and less quantitative investors, are going to move and become steadily more quantitative. Not everybody loves that, but that is the direction we'll go. So more data will be available and be more easily processed. People will have more access to data that used to be hard to get hold of and become easier to get hold of. We've found that faster strategies this year were particularly strong, and they have quite high barriers to entry. So that's a place where we're excited for quantitative strategies. And certainly for us, taking quant into places where other people are not present has been a great place to go. So things that have really been great for us this year, for example, has been applying quantitative strategies to the Chinese markets, which has been really a great opportunity set. What is likely to be harder? Well, I think that strategies which have relied on markets being stable are likely to be harder. And so a key place you might look, for example, credit spreads are incredibly tight right now. If volatility remains high or goes higher, that's pretty inconsistent with credit spreads remaining as tight as they have been today. So that might be one place to look. I think value investing is not terribly well designed to deal with high volatility levels either. And so that might be another place which has obviously had a very bad 2 or 3 years, and if volatility stays high, it might continue to suffer.
I'm so glad you mentioned credit investing here, because a lot of firms at the beginning of this crisis were running high on leverage, and we're seeing leverage rise once again. Do you have any concerns about the return of this leverage and what this might do to funds in the future?
Well, look, firstly, if you think that the world is going to be more volatile, you should need less leverage to get the returns that you want. And so people ought to be adjusting downwards the amount of leverage they have in hedge fund strategies because of this higher volatility environment that we're in. Secondly, I think if we look back at this year, especially March this year, when the pandemic really broke, we had a moment which was very similar, especially in the US Treasury bond market, to 1998 when the LTCM crisis broke. And you had highly levered fixed income funds suffer catastrophic returns. Now, the difference between 98 and this year is that central banks, the Fed and other central banks, intervened much more rapidly than they did in 98. And we managed to sort of fix it. But you essentially had a mini LTCM episode. And those strategies, which have been reliant on high leverage levels, were very intertwined with that crisis. It's very likely to me that over the coming 12 months, regulators will start to look at, well, what really happened in that period? And should we try and control the most levered strategies? Should we try and force less leverage on those strategies?
Sandy, the whole story at the moment seems to be built on central bank largesse and the continuation of very, very low rates and continuation of lots of liquidity sloshing around the system. Everybody expects that to continue forever, as far as I can tell. Is that a flawed concept?
Well, it doesn't look as though there's a lot of short-term pressure on banks to push rates up. And everything you're hearing from central banks is that from their own guidance, they're going to keep rates low. From my perspective, the single thing which would be most likely to cause them to push rates up would be a burst of inflation. There are, of course, many people who are calling for inflation. I do think the challenge in that thesis is inflation in what exactly? And for most of us in our daily lives, we're not feeling inflation in anything at all. Generally, the answer you get back when you talk to people that are bullish that inflation will go up is that you'll see inflation in services. And I must say there's been very little evidence of that so far. So I think a burst of inflation is the key thing that could distort the thesis of low rates for a long period of time. And certainly from my perspective, I haven't seen much signs of that inflation happening yet. So the thesis that market believes in, I think, is actually pretty credible for at least the next couple of years.